The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Evidence over weakness in the economy mounts, and enthusiasm over strength in the market wanes. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I still wouldn't be surprised, though, if we close neutral or positive.
It'll be interesting to see what happens over this next hour.
Yeah, and so let's take a look at where we stand right now. So the S&P is down 0.4%, but it's been quite a ride and an inconsistent ride today at that. Now, the VIX is still up. It's still elevated over 20. You had Charlie McGallagher over at Nomura calling yesterday really a VIX and a VVIX issue that had a massive freak out within the market. I got to say, though, compared to yesterday, this does feel like some relative calm, Romaine.
Yeah, relative calm there when it comes to equities. So a measure of volatility in the U.S. rates market, well, that's rising, at least when measured over the coming month. That is now at the highest going back to July of 2023. You have a key segment of the U.S. Treasury yield curve that briefly turned positive today, and credit spread seeing some more modest but notable widening. And that is the trading backdrop here on this Wednesday afternoon. Amanda Lyman at BlackRock saying, and I'm paraphrasing, it's the economy, stupid.
The credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment.
That growth backdrop looking a tad weaker after data this AM showing job openings sliding to the lowest since 2021, layoffs rising to the highest since March 2023, dismissals at leisure and hospitality companies. That's your biggest drag, and that's reinforcing concern that the consumer is tapped out, and that's bolstering the case for the Fed to finally release the Kraken. But until that happens, don't look to AI or big tech for a reprieve. Yesterday's record-breaking sell-off that we saw in NVIDIA may have attracted some dip buyers today, but that's not enough to ease concern that the linchpin of the 2024 market rally may not be able to carry the load, Alex, for the rest of this market much further.
No, and the 493 stocks might be just great and dandy, but the overall index is going to keep struggling if NVIDIA continues to struggle. So this is a very big chart. So let me walk you through it here. So the bars that you see are the 210 spread, and the white line is the 2-year yield. And I just want to bring your focus to what we've seen over here. So as we've seen the 2-year yield kind of spike up within the last year, right, you wind up seeing a huge differential between the 210 spread. At most, it hit 111 basis points. Now we're basically, you can't even see it, we're pretty much back at neutral as the 2-year yield starts to come down. It's really been that bull flattener that we've seen now at neutral. Now the question becomes, does that tell us anything, Romaine? If having this kind of inverted curve didn't mean that much, does disinversion mean anything in terms of the economic cycle, or is this just kind of the bull flattener as we move into the rate cuts?
That is the big question of the day as we kick you off to the close. Kicking you off with Win Thin, Global Head of Market Strategy over at Brothers Harriman, joining us today here in Studio 2. And let's start off with the hand-wringing over the yield curve once again. I don't know what that's a harbinger of. Either it's the biggest signal that maybe this market's about to really go down, or maybe it's that contrarian signal that we're all just way too worried. Well, I have to be honest, I was one of the many who believed that when the yield curve inverted over a year ago, almost 2 years ago, that we would get a recession. And it's been a very reliable indicator. But we haven't seen it yet. And so the fact that it's going back to a sort of regular slope, I think it's a natural reaction when the market's pricing some of your Fed rate cuts. I personally think the market's getting a little too carried away, as usual. The Fed has been wrong about the Fed this entire cycle. Right. They're pricing anywhere between 100 plus basis points by year end. You think that's too aggressive? Absolutely. By the market. But what about, just look at it from a relative standpoint, because there's been a lot of hay made about the moves that we're seeing in the yield curve, the moves that we're seeing in currencies, at least relative to currencies like the yen, et cetera. That it's that differential between what we're seeing in Europe, rates coming down, a big rate cut in Canada this week, and yet here we are with the Fed still, at least right now, still standing where it stands. That's right. And the Fed is always going to get second guessed, but I think under Chair Powell, it's always been a very cautious, reactive sort of process, and it's no surprise that they're maintaining that. The good news is that when they need to cut or hike, they do it aggressively. So it's in a sense reactive, but once they see the reason to go, they'll do it. So again, I go back to this though.
the jobs data has, I think Mr. Bostic, the Atlanta Fed president, earlier today said something along the lines of, well, the labor market is weakening, but it's not weak.
Right.
I have to agree with that. That's what the Fed wants. We need a little slowing down.
We're slowing. We're not like falling off a cliff.
Yes.
So do the numbers that we're getting justify then consistent 25 basis point hikes? And you think that 50 is definitely off the table? In which case, how much can we continue to see that bull flattener?
Okay, why don't you call me on Friday at 8:31, and that'll be a more definitive answer. Look, right now it's between 25 and 50. We know 25 is teed up, and it's really going to depend, I think, on the jobs data. ADP tomorrow will be sort of a hint, but it's not always a great, reliable indicator. I don't like to put that much weight on any one sort of data point, but given that we're going into a Fed meeting, FOMC meeting, that is a very important one for what they do this meeting. It's just been to me, besides Powell, and Powell was very dovish at Jackson Hole, but besides him, every other, except for maybe Goolsbee, every other Fed official has been very cautious about gradual, cautious. And so they really are going on a very data-dependent approach.
And they're still worried about inflation. They've made that, a lot of Fed officials have made that really clear. They want to be clear on that. Dollar yen, if we continue to see sort of that yield curve disinvert, what happens to the dollar, AKA what happens to the yen and then the carry trade fall off?
Well, I think a big part of that is what's going on with the Bank of Japan. I mean, that was sort of the big sort of game changer back at the end of July 31st. They delivered a surprise cut. It was, hike. I say cut because
everyone else is cutting.
They're bank hiking right now, basically. But they surprised with the hike, and it was a little bit larger than expected. Now, look, you can kind of say, oh, it's only 15, 20 basis points. So what does that really matter? But it's sort of that inflection point where markets say, well, okay, gee, things are changing. So we've had this inflection point between the U.S. cutting, Japan hiking. What's interesting to me is that the Bank of Japan came out afterwards and said, look, with that whole market meltdown that was triggered, they tried to blame the Fed, but it was really, I think a lot of it was really them, what they did in Japan. And they said, look, we're going to stay calm. We're probably not going to do anything until markets calm down. So to me, I think that's sort of a very dovish signal. Yeah. If you look at your great swaps market, MIPR, they're showing only anywhere between 20 and 25 basis points of tightening over 12 months, which is really nothing. That may change as the data changes, but right now it's to me, a very dovish take on the bank.
But what are traders really trying to price in? I'm talking about with regards to the yen. I mean, I know today we saw a 1% strengthening in the yen versus the dollar. We saw the same thing yesterday. Something is going on there. Yeah. Now, whether they're right, I mean, that's a whole other debate, but what are they trying to price in?
Well, I think this week, much of it is the safe haven flows. And we had some real risk off with the NVIDIA meltdown, and it really went across all markets. Commodities were down yesterday. Yeah. Today it's a little calmer, which is I'm kind of heartened because I don't think it's time to press the panic button. But we've seen these bouts of volatility. It tells me that we really are in this sort of inflection point. Everyone's trying to figure out what the Fed is doing. Everyone's trying to figure out if the U.S. is going into recession.
You expect this volatility to continue, though?
Absolutely. I think this will continue well into year end. There's so many moving parts. You add in some geopolitical risk. You've got China in the background. It's just a lot of stuff for markets to digest. But yes, I think say this Friday and then on September 18th, the Fed, that'll clear some things up. Yeah. But it really is so data dependent that even when the Fed goes 25 or 50, we still don't know what's going to coming down the road. I still think if you look even further ahead, there's about over 200 basis points of easing priced in for the Fed over the next 12 months. Right. Again, if that to me is like a recession pricing. Yeah. And I go back to this. The economy is weakening, but it's not weak. We're growing about 2.5% this quarter.
All right, I got to leave it there. Win, always great to talk to you. Win Thin, Global Head of Market Strategy at Brothers Harriman, coming up here on the program with OPEC Plus close to delaying a planned oil production increase, a discussion about the entire energy market with some of the biggest players out there, including the Chairman, President, and CEO of Phillips 66 and the President of Low Carbon Solutions at ExxonMobil.
All right, plus U.S. Steel is facing a meltdown and its deal with Nippon Steel faces a presidential block. Why the metal maker is warning the move could put jobs now at risk.
And of course, a big question right now about the tech sector. Is it still ripe for gains, particularly coming off of that big drop that we saw yesterday in NVIDIA? A lot to talk about here on The Big Show. Stick with us. This is The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
president has been very consistent on this. He believes that American steel companies ought to be American-owned, there's a CFIUS process that needs to occur. This is the kind of potential transaction that we believe is suitable for a CFIUS review, and I really can't go beyond that.
John Kirby there speaking a little bit earlier here about that report that the Biden administration is set now to block that deal by Nippon Steel to buy U.S. Steel, a $14 billion takeover that was immediately scrutinized for some of the national security implications, as well as, of course, some of the concerns here about economic stability at home. Timna Tanners, Managing Director and Equity Research Analyst covering metals and mining for Wolfe Research, joining us right now as you keep an eye on shares of X, now down about 19% here. And Timna, Kirby's talking about this idea that, U.S. steel should be made here in the U.S. I guess the question is, can U.S. steel be made in the U.S. profitably?
Oh, sure, absolutely. I don't think there's any doubt of that. But I think that the Nippon deal was going to keep these union workers employed. And I think it's really clear the distinction there, whereas U.S. Steel came out yesterday and said in some reports that they would likely move their headquarters, shut operations, and kind of starve capital for union operations if the deal doesn't go through. So it's a kind of baffling outcome today if indeed the president's going to block the deal.
I am curious. I mean, we've been talking a lot about the sort of the history of U.S. steel making in America, how a lot of that, of course, has been offshored. And, of course, the idea that this has become a political football. You go back to the 90s and then the 2000s and, of course, the Trump administration and now the Biden administration. For those steel companies and other metals producers, for that matter, here in the U.S., is there going to be any reprieve from this? Or is this kind of our future where it's going to be Washington more or less dictating the future of these companies?
Look, I think that if it weren't for an election year, I think this deal would have gone through. I think there's been plenty of examples over the decades that I've covered the sector where there's been more ownership by foreign entities. And in fact, Cliffs is buying Stelco in Canada, and Canada didn't make a stink. So there's ownership that's cross countries all the time. I just think this is really politicized this year. And there's plenty of steel makers in the U.S. that are very profitable and have been so over the last several years.
Okay, so then if we're taking it in stride a little bit, U.S. steel stock is down 19%. It was halted. You look at intraday, and it's just like a straight line down once that news broke. Is this an overreaction here?
I think so. And I think that, either the deal goes through and it's $55. That's looking less obvious. If obviously the president blocks it, that's not happening. But on the other hand, what's U.S. steel worth on a standalone basis? And what we've written is that we think it's worth $44 on a standalone basis because they have a $565 million breakup fee they benefit from if the deal doesn't go through, which is $2 alone. And then when we do some math, and I think are talking to investors about this, it's really up to what's the valuation of the company on a standalone basis. But 20% move after the fact that it was clearly not valuing the deal going through before that seems like an overreaction, yes, to us.
So to that point, do you think there's a possibility that Cleveland Cliffs comes back and makes another bid now that the U.S. government is getting more aggressive here?
Yeah, no, there's no chance that Cliffs does it in the short term. That's an easy no. The more difficult answer is in the long term, right? And in our view, Cliffs would be restricted from buying U.S. steel just because of the concentration of supply to so many customers, especially in key consuming industries such as automotive and appliance. So very clearly excess concentration. But now that Cliffs is planning to buy Stelco, and that deal's supposed to close shortly, there'd be even more of an excess concentration problem. So in our view, there's not an obvious alternative buyer, especially if there's no international buyer that can come in and buy U.S. steel.
Are there options for more kind of strategic type partnerships that doesn't necessarily include sort of a wholesale change in ownership?
Yeah, maybe. I mean, again, you're talking about collusion potentially if you have too many of the U.S. players joining forces. There's a couple smaller names that have been on the block for a while that could be interesting. Problem is that at least 2 or 3 of those are Russian-owned still, and that's probably difficult to take out. How you do that logistically for now, I think, is tricky. But some more consolidation that could happen. We just think it'll be smaller scale going forward.
Why is it so hard for U.S. steel to get it together and to go it alone?
I think that U.S. Steel faces a few challenges. They've starved some of their assets over the years. The blast furnace assets need at least, off the top of my head, $1.5 billion, probably closer to $2 billion to kind of get them up to speed. And then do you make that investment if you think that the world is shifting away from blast furnace and toward greener steel? I think that's still a debating point, honestly. I'm not convinced that has to be the case. But these are old assets. Some of these assets have been around for over a century. So do you want to keep investing in them, or do they want to pivot to lower cost operations? So their plan has been to shut some of these older operations that happen to be union run. And if they succeed in that, then I'd say that in the next couple of years, there'll be a lot fewer union jobs under U.S. Steel.
Right. Definitely a head scratcher then. All right, Timna, thanks a lot. Really appreciate it. Timna Tanners over at Wolfe Research. Nevertheless, that stock is down 20%.
Yeah, 20% worst day in several years here. Meanwhile, the broader market remains on the back foot with the NASDAQ 100 still sinking after yesterday's sell-off. Right now, down about 0.5%, down 8% from its highs. And of course, a lot of questions right now about the mania surrounding artificial intelligence. Did it go too far, or is this just a reset? That conversation coming up next. This is The Close on Bloomberg. Let's get right to our top calls. The movers on the back of analyst recommendations. And we start off with Sweetgreen, a fresh buy rating over at TD Cowen on the hopes the salad chain can achieve 5% same-store sales growth in 2025. The analyst pointing to the relaunch of a loyalty program and faster service. Those shares up 2.5%. Next up, Supermicro, cut to equal weight over at Barclays. The analyst seeing uncertainty regarding AI server margins and limited short-term visibility. Seen a lot of room for improvement in internal operations as well. Those shares down 5%. And let's take a look at Amphenol, a supplier of fiber optic connectors, cables, and data center parts. Bank of America cutting to neutral. This after NVIDIA changed the design for one of its server platforms to which Amphenol supplies components, and that could hurt the company going forward. Those shares down about 1%, and those are some of our top calls.
All right, speaking of NVIDIA, you got the stock down 11% in 2 days. Mag 7 overall down about 3.5%. Joining us now is Dan Niles, founder and portfolio manager at Niles Investment Management. Here's the basic question. Do you buy the dip in the Mag 7?
Well, I don't think you can view it as Mag 7. I think you really have to get into the individual names because they all really have different fundamentals going on. And the easiest way to think about it is if you think of the 3 big hyperscalers, Amazon, Google, Microsoft, they all reported the June quarter, but had estimates go down for the future quarters. Meanwhile, you look at Apple and Meta, they both beat revenues and EPS for the June quarters and then had forward numbers go up. Mm-hmm. So it's a very different situation. So I think you have to look at them individually. We like Apple and Meta, and we have mixed to negative feelings on all the rest of the Mag 7.
So is the Meta and Apple play also because those are the companies that are more exposed in essence to the consumer?
No, not really. I mean, with Meta, if you think about it, they beat and raised. Google lowered the forward numbers. And they're both in the same business. They're in online advertising. The difference is Meta is increasing their spend to AI, but that's showing some returns because they're figuring out, hey, these are the videos that Alex wants to see, and these are the ads that Alex is willing to watch. And so they're doing a really good job of leveraging their AI investments. And with Apple, it's a case of you have 1.2 billion installed base of iPhones around the world, but less than 10% of them can run the new AI features that Apple's going to introduce this upcoming Monday. And that, I think, will lead to an upgrade cycle, which we last had during COVID when we all had to figure out how to exist when you couldn't go out.
How viable, though, do you think some of these AI options are going to be? I'm talking about the consumer-facing options that Apple and some of these other companies are sort of promising for us. Do you think that's going to be enough to tantalize folks? I mean, beyond just, we all played around with ChatGPT back in late 2022, 2023. It was fun, but there were a lot of people that didn't see sort of the long-term purpose in their life out of it.
Well, it's like the internet. If you think back to 1998, and during one of the many downturns you had from the end of 94, where this thing called an internet web browser came out from Netscape, and what the heck's the internet? In 1998, one of the Nobel Prize-winning economists came out and said, I think we'll know that in 5 years from now that the internet was no more, changing the world than the fax machine. Mm-hmm. Clearly, that was not the case.
Yeah.
And so I think with the new AI features coming out, are they going to start off slow and are they going to grow over time? Much like with the internet, I think the answer is yes. And I love using the AI features right now for the different services that I'm using because it really is speeding up my workflow. It's really helping me quite a bit. And I think consumers are tired of having to click on links to get answers. They can just ask the question and get the answer.
Yeah.
That would be a lot more preferable.
But there needs to be a little bit more depth. And I understand there's kind of different versions out there. So a lot of us who have played around with it, we're kind of using the more stripped down versions of it. I am curious, though, too, and I just want to read you a quote. And this is from John McCarthy, basically kind of considered the father of AI. He passed away several years ago. But he gave a great interview back in 1995. And I thought it applies to today. He says, it's not the lack of machine capacity that is holding back the development of AI, but it's our inability to write programs that take full advantage of what we already have. And I think about it in the context of how we focus so much on these chips that NVIDIA is producing and maybe AMD and some of these other companies, and a little bit less on the fact that a lot of what we need to really accelerate AI is already there, Dan. I just want to know where those investments can be made.
Well, I think one of the things you said right there is that you can use AI to speed up a lot of things. And my son's doing a startup and he's using some of the features in the latest AI services out there to help write code. Now he goes, yeah, it's probably the equivalent of hiring a C or B level programmer, but then you can go ahead and much like if you hired an intern, then go ahead and make that a whole lot better. And so I think you're seeing it starting to replace white collar jobs in different sectors. Now, was it overhyped near term? Absolutely. But as Bill Gates said, all new technology is overhyped near term and underhyped long term. And you even saw that with the internet. And I don't think this is any different. AI is the dumbest it's ever going to be today. It's just going to get smarter from here and be more productive and help us do our jobs better. And it's already affected my life. And most of the people I talk to, it's helped improve their productivity. There's obviously mixed bags, and you have to double check things like you would with any employee or intern that you hire. But that just is part of the territory with this. You can't just take everything as 100% accurate.
All right, Dan, always great to get your insights. Dan Niles there. He's the founder and portfolio manager over at Niles Investment Management. Keeping an eye on NVIDIA. We should point out, of course, it had that big drop yesterday, Alex, down about 9.5% here. It was higher by 5% today, now dipping into the red, down 2.3% as we head towards the close.
Yeah, I like that idea that like AI is the dumbest now than it's ever going to be. That's how I feel before I have my coffee in the morning. Like that moment when I wake up, I'm definitely the dumbest I'm going to be. But it is interesting. There was a great article out from Bloomberg that was talking about sort of the founder risk and like to get the really good, super sexy companies, do you need that star power CEO or not? Yeah, well, the micromanaging star power CEO. I mean, I mean, if your name's on the building, like maybe it's okay. All right, anyway, coming up, all about the energy. We're going to talk to Mark Lashier of Phillips 66, Dan Ammann of ExxonMobil Low Carbon Solutions. Both of them will be joining us in the studio. This is The Close on Bloomberg.
It did sell off based upon concerns around China. No, I'm not going to argue Chinese demand growth is robust in any shape or form. And yes, they have structural problems on the longer term outlook. But by all means, it's not a collapse that would justify the market being as short today as it was in the global financial crisis of 2008.
That was Jeff Curry, Chief Strategy Officer of Energy Pathways over at Carlyle. That was right here on The Close yesterday, discussing what he sees, Alex, as the biggest concerns right now in the oil and energy markets. And in fact, right now, as we count you down to the close, there's about 30 minutes left. We did get settlement once again here of crude oil here in New York and, of course, over in London. Another down day. WTI now below $70 a barrel. I know. Yeah. 69 is where we sit for WTI. So if one person knows refining energy, it's definitely a refiner, and that's Phillips 66. They have 9 refiners globally. They also just converted a plant
plant from crude oil processing to renewable fuel. So here in the studio with us is Mark Lashier. He's a chairman, president, and CEO of Phillips 66. Mark, it's great to see you.
Great to be here, Alex.
So I look at $68 oil. I'm like, oh man, demand must be terrible. Take a look at the pump prices. They're under $3. What do you see on demand?
It's been a little soft this year. We saw it in diesel earlier this year, and it continued into driving season with gasoline this summer. It's not terrible, but I think it's just a symptom of high interest rates doing their job, slowing the economy down. And I think particularly at the low income end of the spectrum, gasoline probably was an impact this summer. We had 2 great years. Refineries ran well. 22, 23 had great margins. Everybody fixed everything, and they're running extraordinarily well. So that's kind of added to the supply and demand. The supply has been really strong this year. Demand has been kind of flat to maybe a little weak, but exports have been pretty good.
So what's your strategy then? We go into fall maintenance season anyway. So do you want to get into fall maintenance season quickly because the demand area is really soft, or do you want to wait, or do you see margins changing soon?
No, we'll stay with our plans around turnaround season and shut things down and fix things per the normal schedule. It's hard to change those things very drastically, but going forward, I think if we hit the soft landing and the economy firms up, I think things will be fine. You don't see enough global capacity coming on to meet global demand in the near term, and we're going to see, I think, some more rationalization globally next year. So that'll take 600,000-700,000 barrels a day of capacity out. So things are constructive in the medium to long term for refining,
and constructive also on the economic side of it too, right?
Yes.
Because so that's what you mean.
Absolutely.
So, but if we are seeing softness in the economy, particularly when it comes to the consumer side of this economy here, and you do see a pullback in travel or maybe people spending on those types of things, how do you adjust if you need to at all?
Well, the U.S. has become very competitive in refining, competitive on a global basis, and we're able to export and compete on a global market. So I don't think you'll see economic pullback. We're still seeing margins that incent people to run, but other places in the world, people are starting back off refining runs. They're starting to shut down other refineries that aren't so competitive, and so we're able to compete out in the world markets.
66, it's been a well-run business, but as you know, there are some investors that want to squeeze a little bit more out of it. Elliott has taken a stake in the company. I'm curious what your relationship is right now with the folks over at Elliott. What are they asking for? What are you willing to give?
They're like any big investor. We meet with them frequently. They express their concerns, and we have a good relationship with them. It's been constructive. We don't mind investors that hold us accountable for what we've committed to do, and we've committed to do a number of strategic things.
And one of those things is greening stuff, if I just say it like that. And you took one.
Is that a technical term?
It is a technical term. In Rodeo Refinery, you moved that from processing crude to processing renewable fuel, and it was a $1.2 billion investment, but it was a big one.
Yes.
Is this more like what Elliott wants, or do they want you to stick to the knitting?
Well, that was well underway before we engaged with Elliott, but they want us to see successful investments. They want us to be a disciplined investor. They want to make sure that we're returning great returns to shareholders, and we're aligned with them on many of the things that we've talked about. But that green investment that you talked about, we took a 125-year-old refinery that, frankly, was built to replace whale oil with kerosene. So we've been transitioning for a long time.
All right.
And it's been processing crude oil ever since last January. We took it off a diet of crude oil. We did the retrofit that we needed to do, and since a few months ago, we've been feeding a number of low-carbon renewable feedstocks to the refinery, 50,000 barrels a day. It's been a great startup, and we're making renewable diesel and aviation fuel today.
What is it like to get offtake agreements? Like, I'm sure the demand is there, but my concern is the price. Like, who has the power on price, and are the customers willing to pay up if they have to?
One of the advantages we have on the West Coast is we've got a retail presence, so we're able to take that renewable diesel direct to the end-use consumer. You could, if you had a diesel truck in California, you could pull up to a 76 station, and you could fill it up with renewable diesel, and it actually would run a little better than on traditional diesel. So it's been a well-received product. We've been making it at a smaller scale for a couple of years in California, so we know the markets and we know how to capture the most value in the marketplace.
Well, speaking of California, can you talk a little bit here about some of the requirements for stockpiling fuel, how you've adjusted to that?
Well, none of the requirements have been put in place yet. I think it's just a political conversation at this point. We believe that the markets will take care of things. When we took Rodeo off of crude oil, we stopped producing gasoline, and within a few months there was an excess of gasoline supply into California because the market responded. You saw imports coming from Asia, from the Northwest, from the Pacific Northwest to replace the gasoline that we took out of the market. So markets work. Markets respond.
any concerns here about the election that we're going through right now and the potential change, if at all, in energy policy?
Well, I think that elections always create some uncertainty and markets don't like uncertainty. We would like to just see a predictable future, and we'd like to see permitting reform. There's a lot of things that were instituted in the IRA that are difficult to execute because you can't get the permits that you need for CO2 pipelines, for electrical transmission lines. And so there needs to be some rational permitting reform take place for us to do the things that we can do to help the energy transition.
That was like the best lead into our next guest. Thanks, Mark. You should write our copy for us.
I'd love to, Alex. Just give me a chance.
That was amazing. Hey, Mark, that was really great. Come back. We'd love to get your take on sort of demand and how you're making this energy transition as you keep going.
All right.
All right, good to see you, Mark Lashier, President and CEO of Phillips 66. I really couldn't make a better lead-in to this, but let's stay with the energy transition. So Exxon's spending about $20 billion through 2027 on its low-carbon future. And just today, Exxon announced that ADNOC will acquire a 35% stake in its hydrogen project in Baytown, Texas. Talk about permitting reform and hard-to-get pipes in the ground. Here in the studio with more is Dan Ammann, President of Low Carbon Solutions over at ExxonMobil. Dan, good to see you.
Great to be here.
So tell me how this deal came about with ADNOC, and how was it? Did it take a long time? What was the value like?
Sure. So ExxonMobil and ADNOC have had a relationship in the upstream side of the business for a very long time. So they've been a great partner. We've been a partner of theirs globally. So it makes sense to bring on partners that we're comfortable with into these projects in these brand new global energy value chains as we're building them out. So ADNOC brings some capability. They're building out on the ammonia side, particularly in Europe. Ammonia, as you know, is one of the things that we're building. In addition to the hydrogen plant, we're adding an ammonia loop on there. So it was a very natural linkage, long-standing partnership. The actual deal itself, came together relatively quickly over the space of a matter of months, but it's going to be a great partnership going forward.
So let's just break that down for a second. So this is a hydrogen project. It has a lot of capability. You could further refine the hydrogen into ammonia, but it's going to be powered by natural gas, which makes it blue. So you can still capture the carbon, but it's still powered by natural gas and not wind and solar.
That's exactly right.
Talk to me then about policy, because there is a 45V tax credit in the IRA, but that has to be hydrogen produced by wind and solar. Yours would not be. How does this conversation play out with ADNOC? How is it playing out with the government right now?
Well, we've been very consistent all along. You really need three things to come together to take on a world-scale project in a new value chain like this. You obviously need the supply to come together, so the development of the project, the engineering of the project, understanding the cost of the project. You obviously need demand and offtake for the project, so for the hydrogen and ammonia, and we're seeing a lot of traction in the marketplace on that. And then the third ingredient, as you point out, is the support of policy and having that come together. And our position on the policy has been quite clear, which is policy should be around, and I think the legislative intent of the IRA was around technology neutral and carbon intensity based. And so that's very consistent with the project that we're developing. It's going to have a very low carbon intensity hydrogen. And all we're asking for is for that low carbon intensity to be recognized and for the tax credits associated with the project to reflect the underlying carbon intensity on a technology neutral basis.
What's the feedback that you're getting from Washington specifically on that point, though? Are they receptive?
Yeah, I think we've been very, very clear in our position. We've been clear with all of the people that have come on board with the project, with ADNOC, with JIRA, who we signed a heads of agreement for offtake and equity investment, with Air Liquide, who's come on board on the project, and with the administration and with the different branches of government as to this is what we're looking for, this is what's necessary for a project like this to proceed. And we've been just very direct and straightforward about that.
I want to switch gears and talk a little bit about where we stand right now with lithium development and the lithium projects there. Not just how far along is it, but is it still economically viable for you as a company?
Yeah, I mean, the foundational work that we did as we began this project was to look at the supply and demand for lithium, not just over the next year or two, but over the coming decades. And when we look at getting into a new business or an additional business, we take a foundational view built on the fundamentals over a long period of time. Our view is that there will be a significant growth in lithium demand over the next couple of decades, that the current supply base is not set up to meet that, and that there will be new sources of supply that are required to come online to meet that. So that's the foundational premise underlying the approach. We then look at it and say, well, what fundamental advantages does ExxonMobil bring to lithium production? And we bring a lot of existing know-how, obviously, on drilling wells, on producing water, on extracting chemicals from that. And so if we convince ourselves that we have a good resource, which we do, and if we can convince ourselves that we bring real advantage to that, then we'll have a firm foundation for a project going forward.
Which kind of brings us back to what Mark was talking about with like putting things in the ground and how difficult that can really be, which is why Exxon buys Danbury, because then you have access to carbon moving pipelines without having to build them yourself. Like that's a lot of how the partnerships, it seems like you're thinking about it, right? What else do you think needs to be done on that front? Like, what else do you need to buy rather than build?
I think the fundamental...
Or partner rather than build.
Yeah, the overall approach is one of building these projects organically. We bring a lot of capability to the table to do that. Mm-hmm. If we see an opportunity where someone can bring something that we don't have, or they can bring it more quickly or more cheaply or more efficiently, then that's something that we'll look at. And if you look at the partnerships that we've done, if you look at take the hydrogen project as an example, we brought Air Liquide on as a partner because they have an existing hydrogen pipeline network that we can then distribute the hydrogen through rather than having to go and build that ourselves. The acquisition of Denbury brought CO2 infrastructure in-house for us and gave us a much bigger, more scalable footprint for carbon capture and storage to build from. So that's really the lens that we look at it through, which is, where does something accelerate our efforts or bring something that we don't have? I'd say at this point in time, we have a lot of the ingredients that we need to get these initial projects off the ground, but we're always open to exploring partnerships where that real value add can come.
How nervous are you about the beginning of November? I know you're not going to talk to me about policy. What happens
what's
in
happening
November?
in the beginning of November?
I mean, nothing. It's vacay. No, but I mean, as in, how much of how you guys are set up is due to policy? And hydrogen is a good example of that.
Well, we're I guess, depends on the time frame. In the long run, we need the market forces to take over and to drive these low carbon businesses. We need the demand, and we need it to be market-driven demand. At the same time, we definitely need policy support in these initial projects to get them off the ground and to get the flywheel going and to get onto the cost curve so that we can bring the cost down so that the market's better able to pick this up at a later date. Having said that, the business we're building here, we're building a foundation for a business that's going to grow over the coming decades. This is not all about the next year or two. Obviously, we have election cycles, but we need to build a business that's resilient to the political cycle. Obviously, we're paying attention to what's going on. We're taking a very principled approach in the things that we're looking for in terms of support. And we'll see how things shake out.
Is the commitment, though, still there? I mean, not just at the sort of the government level, but I mean, we've seen so many companies now start to talk about at least scaling back some of those ambitions. I mean, on the EV front, which I know you're very familiar with, we've seen Volkswagen and some other companies, Volvo, basically say, look, some of those aggressive targets at, all electric type of lineups, that's been pulled back. We've seen some of the energy companies even say that some of the renewable energy initiatives, or at least the targets to get some of those initiatives out by 2025, 2030, 2035, not realistic here. Is that commitment still there long term?
Yeah, I think we sort of bring it back to the fundamentals and say, what is necessary to make one of these projects go? And I talked about the supply, the demand, and the supporting policy. And as those three things, and when those three things come together, we'll be in a position to FID a project like the Baytown project. And so it's very focused on, what are the things that have to be true? What needs to come together? We've certainly seen a lot more press releases than we've seen final investment decisions, particularly in the low carbon space. And I think we'll see that continue. But I think when we have world scale projects, when you bring fundamental advantage to those projects, like we believe that we do at ExxonMobil for projects, like the Baytown hydrogen project, that will give us the best possible chance of making these projects happen.
Dan, it's a great conversation and really appreciate you joining us today.
Thank you very much.
Absolutely. Dan Ammann there, he's president of Low Carbon Solutions over at ExxonMobil. While we were speaking, we did get some breaking news. This involving HPS. This was the private credit arm sort of carved out from JP Morgan. Bloomberg reporters now learning that company does plan to go public. According to people familiar with the situation, HPS has begun discussing an initial public offering that could value it at about $10 billion or more. Again, this is a private credit manager with about $117 billion in assets under management. Still awaiting a word out of HPS on this, but our reporters, according to people familiar with the situation, saying that we could get some details on this as soon as next week. A lot coming up here as we continue to count you down to the close. Just about 15 minutes to go. Stocks off session lows, but still in the red. Amanda Agati waiting in the wings, Chief Investment Officer over at PNC Asset Management Group. She's going to help us count you down to those bells. This is The Close on Bloomberg.
going back to a sort of regular slope. I think it's a natural reaction when the market's pricing in some of your Fed rate cuts. I personally think the market's getting a little too carried away, as usual. The Fed has been wrong about the Fed this entire cycle.
Right.
They're pricing anywhere between 100 plus basis points by year end.
Went then over at Brothers Harriman joined the big program to kick us off to the close just about 10 minutes ago here. The day started, Alex. It looked like we were going to have a bit of a rebound coming off of yesterday's sell-off. That faded in a big way, but we should point out this isn't like a sell-off that we're looking at right now. We're kind of flatline, as I think a lot of people still waiting to see that jobs data, the official jobs data on Friday.
Well, and then I called it. I was emailing with Mike McKee at like 8 a.m. this morning, and I was like, I think we're going to close up or flat today. And we might just close up or flat today. It just shows the inconsistency of the sell-off, basically.
Did the JOLTS data not jolt you at all?
It did not jolt me.
Yeah.
No, it just confirmed we already know. It's like a Rorschach test.
Yeah, exactly. But it gets to the point too. I mean, like, we still haven't heard from the Fed, and I think we kind of need to. I mean, at least I want to. I don't know about you, but but it gets to this idea here that we're all just playing this guessing game about 25, 50, or however many extra cuts we might get before the year's end. And at the end of the day, we need to see them put their cards on the table.
Yep, we have things with two speakers and the blackout period, and then we have the jobs. So there's not a lot we're going to get from them until the 18th.
Yeah, on the day here where we're seeing the VIX back up around 21 here. The dollar mix here on the day, and of course still seeing an additional drop in Treasury yields for a second day. Amanda Agati, she's the Chief Investment Officer over at PNC Asset Management. Pleased to say she joins us right now to help us count you down to those closing bells. 8 minutes to go here, Amanda, and there's a lot of questions, I think, not about necessarily what happens today, but really over the next few weeks, once the Fed does have that big meeting on September 17th and 18th, and I think more importantly, once we get back, believe it or not, into yet another earnings season. We've got this yin-yang between the macro and, of course, corporate fundamentals here, and I'm wondering, when you look at them together, is it painting an encouraging picture?
Well, it's always nice to be with you, and I hate to start off on a little bit more of a bearish note, but it's not particularly encouraging when we look at the underlying fundamentals for where Q3 earnings season is likely to land. We've seen a decent amount of negative revisions. The quarter is not yet over. We still have a better part of a month to go here. But the earnings growth backdrop for the S&P 500 is kind of grinding to a halt here for Q3. So after exiting the earnings recession officially in Q2 earnings season, we're kind of back to about zero here expectation for the third quarter. And that just feels not particularly positive, given that equities are still very much priced to perfection in this environment.
Do you think that, though, some of these companies still have room to cut costs in a way that helps to sort of support those earnings and their margins in the way that we kind of saw over the last couple of quarters? Because the revenue growth has been coming down. We know that. But a lot of these companies have really surprised by saying, look, we tighten our belts and boom, here you go, investors.
Well, they certainly tightened their belts as a function of last year and everybody being really concerned about tipping into recession. Of course, it was the most highly anticipated recession that failed to materialize. So there's been a lot of prep in tightening things up coming into this year. I think there is still certainly room. You just have to take a little bit more of a draconian approach to cutting expenses and kind of focusing on margins here. We're about 150, 160 basis points off the cycle high from a margin perspective. So it is definitely late innings and companies are definitely feeling the pressure. But I think there are still some levers that companies can pull yet. And it really wasn't a key theme coming out of Q2 earnings season. It may very well be a hot topic for Q3.
So what's your playbook then?
The playbook is the same playbook. I feel like I've been a broken record for the better part of the last year or 18 months or so, and it's really focused on quality. We're thinking about quality in a couple of different ways, but thinking about quality from a capitalization and style perspective. We want strong, defendable margins in an environment where margin compression is happening. It's harder to find. It's a bit more elusive, but we're trying to focus on companies that tend to be high quality at various points in the cycle, a diverse basket of equities. We're not backing up the truck, sadly, in some of the high-flying tech names, though they have had a little bit of a quality tilt here up until recently. It's just very hard to back up the truck at these valuation levels. So quality is the name of the game, really, on the equity side. It's also very much the name of the game on the fixed income side, too, right now.
Well, that's what I was going to ask. Are you jumping on the bond bull there, or are you going to go take a little credit risk?
I do think there's a little bit more opportunity on the fixed income side of the equation. It pains me to say that as very much an equity girl at heart here, but I think given some of the volatility, some of the moves and rates that we've seen here, I do think that there are a bit more opportunities in fixed income for investors to put capital to work here. I would love to get a little bit more exposure to high yield loans, the below investment grade part of the market. But given where spreads are, I'm not sure that's quite the right place to be backing up the truck yet. Investors aren't really getting paid to take on that level of risk, and we're still very much late innings of the cycle. Even though we think a soft landing is the base case, it's still late innings, and so I think it's a little early to take on that kind of credit risk.
Amanda, I've got to ask you here just about the tech trade. I mean, that really has been the linchpin of the rally that we saw this year and even for a good chunk of last year. I am curious, Amanda, if long term, because that trade was sort of based on these sort of moonshots, do you still see life there, even if the fundamentals in the here and now aren't necessarily there?
Well, absolutely. I mean, if you're focused on a multi-year horizon, there's a ton of secular growth opportunities in all things technology, AI, automation. We are absolutely bulls on the innovation cycle that's being born right now in those areas. And we think there's so many potential use cases to come that there's a lot of opportunity for investors. But I think investors need to get away from fixating on one or two names. Like NVIDIA has been the only game in town. There's much more of a kind of broader market story that needs to play out here. And I don't think investors have really sort of widened their aperture as it relates to where those opportunities may be. So we're seeing a lot of crowding into a very small basket of technology names. That's worked okay up to this point, but I think at these valuation levels, you got to think a little bit more creatively.
Amanda Agati, PNC Asset Management, our thanks to her as we count you down to the bells. And speaking of NVIDIA, that company now out with a statement saying it hasn't been subpoenaed by the U.S. Justice Department. Of course, Bloomberg News reported yesterday that the Justice Department had subpoenaed NVIDIA and several other companies as part of an antitrust probe into some of its, AI business practices. Now, a headline without not much else context there, Alex, saying that NVIDIA says we have not been subpoenaed by DOJ.
Yeah? I mean, is that the question? I mean, I don't know. You talked to Mandeep Singh of Bloomberg Intelligence, and there's clearly a lot of overlap that definitely should be looked at, and pricing power that you have to argue is legit or not. Yeah, and we actually already know, of course, that there is some sort of investigation going on. Whether a formal subpoena has been issued, I don't know. Maybe we're getting into semantics, but we will break it down for you right now as we count you down to the bells on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you to the closing bell. A global simulcast starts right now. Scarlett Fu joining us in the TV studio. Tim Stenovic in the radio booth. Emily Grafeo filling in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on day 2 of the great sell-off, Tim Stenovic. Sell-off, at least for the S&P 500. Yeah. It is 0.1%.
Yeah, okay, great. Yeah, not so great if you're measuring it that way. I think that's important, though. It's a choppy session, sort of, I think, surprising to folks who saw, what happened yesterday into the close. I don't want to steal Alex's thunder, but I think the real action today, Emily, was in the bond market.
Oh, that hurts.
I'm sorry. It's just a deep tease, okay?
We'll let Alex get to the volatility and the action in the bond market. But I don't know how surprising the sell-off is, just given the seasonality in September. It is historically a weak month for stocks.
It is historically a weak month, and maybe that's creating the situation that we're in, where people expect it to be a weak month, so they sell off in anticipation of that at the start of the month, and then it becomes a self-fulfilling prophecy. Nonetheless, you do have headlines that aren't helping, whether it's the JOLTS report or whether it's stuff out of Washington with Joe Biden, for instance, reportedly planning to nix the Nippon Steel and U.S. Steel deal.
Well, also, and we'll get to bonds in a second, but not to forget too that if you had funds re-lever in the last few weeks of August, had they now closed out some of those positions and sort of had to sell then into the move.
All right, well, this was kind of a topsy-turvy type of day here that we saw in the market for all of the major indices. Most of them actually did open in the red, but spent a significant amount of the session in the green. The net result of it, though, is a relatively flat day. A Dow Jones Industrial Average is going to finish in the green, but only by about 26 or 30. We'll call it about 40 points here as we wait for these numbers to settle. That's only about 0.1%. The S&P 500 also down about 10 points or about 0.2%, while the NASDAQ Composite is going to finish lower by roughly 50 points or 0.3%. Your Russell 2000, there it is on the screen, 4 points down, or about 0.2%.
Taking a look at the S&P 500, not quite an even split between gainers and decliners in there. We did see 243 stocks advance today. We did see 259 stocks move lower.
Yeah, pretty even split too when you look at the sector performers in the S&P 500. Utilities, consumer staples, and REITs are the best performers. So clearly a move to more defensive sectors in terms of gainers. And in terms of decliners, energy stocks down 1.4% as oil prices fall to their session lows. Materials and tech each off by at least 0.4%.
Okay, let's take a look at some of those stocks that did move higher. I want to start with Mondelez International. Actually had its best day in more than 4 years.
Oh, Oreos.
Look at that.
Yeah.
Higher by 4%.
Wow.
This is after the CFO, Luca Zaramella, said during the Barclays Global Consumer Staples Conference that the company's executives feel, quote, quite good about the back half of the year. I think you will be pleased with the numbers you're going to see in the third quarter. He said that July and August trends were good in Europe, and in the U.S., the most recent numbers on category and share performance were also good. Shares climbing by more than 4%.
Did you know they make
today.
an Oreo cereal, and it's literally just little cookies like in a box?
Don't tell the kids that.
That sounds great. I was never allowed to eat any of that stuff.
Me neither.
When I was a kid.
So deprived we were.
Yeah, and guess what? I don't let my kids eat that stuff either. So what goes around comes around, I guess. I don't know. Wow,
it's also gross.
Tough
but,
alpha
you know,
there.
Anyway.
No, it sounds really good. I don't know about you guys.
I'm not even going to get you started on what they serve in schools here, because apparently you can get, chocolate milk in your cereal, but it's fine. Frontier Communications is another stock that did end up moving higher today. Fiber US, FYBR, is the ticker there. This is a result of some potential M&A happening. Look at that, more than 37% to the upside, 38% to the upside if we round that up. Verizon has advanced talks to acquire rival telecom operator Frontier Communications Parent Incorporated, according to a person familiar with the negotiations. An all-cash deal between
person?
I'm never going to reveal the sources. I have no idea. Do you know who it is, Romain?
No.
Yeah. I will say that an all-cash deal between the two companies could be announced as soon as Thursday. A representative for Frontier declined to comment. A spokesperson for Verizon didn't immediately respond to a request for comment. Bloomberg News reported this and earlier reported by the Wall Street Journal. And then we were covering GitLab results yesterday after the bell. Shares did move higher in trading today. Shares higher by more than 21%. This after GitLab reported second quarter results that beat expectations and raised its full year forecast, Emily.
All right, well, I'm looking at the decliners. First off, United States Steel Corp ticker X fell 17% in the regular session as its peers also declined. It was the biggest full-day retreat since April 2017 after President Joe Biden is preparing to block the Nippon Steel Corp's $14.1 billion takeover of United States Steel, according to people familiar with the matter. And Romain, I don't know those people and I won't reveal them. Trading volume in the stock was almost 17 times the 20-day average. I'm also looking at Celsius Holdings. This is a maker of very popular energy drinks. Yeah, this stock
literally like everyone on our team drinks this. Like they're all like wired up.
I've never had it.
Yeah. Also, if you go into
I might exaggerate a little bit, but
they
it's
have
close
like
to everybody.
25 different flavors. But the stock dropped as much as 11%, the most intraday since July, after management said that its distribution partner PepsiCo is reducing its orders by as much as $120 million in the third quarter versus the prior year. So that stock lower. And then finally, Dollar Tree, those shares sliding as much as 25%, reaching the lowest intraday level since March 2020. After the discount retailer lowered the full year projections for sales and profit. And we also saw a downgrade over at JP Morgan on Dollar Tree shares.
Yeah,
you don't drink that stuff, do you?
No.
Celsius and all that. I don't know
you
what's
serious?
in that stuff.
Sugar and grossness. I don't know.
Oh, wow.
I'm told it's rocket fuel.
No, actually, I'm told it's quite good, and I'm sure it's really great. I just can't have that much sugar. That's not pure chocolate.
The back of
we
the
can have
can
this debate
says-
now.
Are we back-
Again,
oh,
we're
gosh.
back to the chocolate debate.
I was just starting to like you, Alex.
Yeah.
You're back to chocolate
Tough
now?
stuff, yeah. He likes the gummies. I like the chocolate. It's a whole thing.
They
Okay.
tell you not to drink more than 2 if you read the back of the
Not
can.
more than 2. I mean, you can
2
say
per
that
day.
about coffee also. All right, let's get to the real action, guys. Whatever Dollar Tree. Taking a look at the bond market. A nice bid all across the curve. That 210 spread coming in. It flipped into disinversion territory, and now we're still short by about 1 basis point. But the buying was already there even before you got that JOLTS number. I guess the question still becomes, day 2, do you buy into the bond rally?
Yeah, absolutely here. You know what, guys? Apparently earnings season actually never stops. HPE, this is Hewlett Packard Enterprises, those earnings crossing the wire right now. Their fiscal third quarter numbers looking somewhat good. $7.71 billion in revenue in the most recent quarter. Street was looking for 7.6. APS coming in at 50 cents a share. The Street was looking for 47. Here's your guidance going forward. For the full year, the company sees adjusted EPS at $1.92 to $1.97. That's higher than its previous estimate of what it saw of about $1.85 to $1.95. The initial share price reaction is slightly to the upside.
All right, let's take a look at C3AI as well. The ticker here is pretty simple, AI. Adjusted loss for the first quarter, fiscal first quarter, was 5 cents. Analysts were looking for a loss of 13 cents, so a narrower loss than anticipated. In terms of revenue, $87.2 million, bang in line with analyst estimates. The subscription revenue missing the consensus estimate. So you are looking at a big decline in the stock right now, 13.5% loss. So that hand-wringing over all the AI names continues.
Okay, I'm watching what's going on over at Credo Tech. First quarter revenue meet estimates. First quarter adjusted earnings per share coming in at 4 cents. Estimates were for 4.1 cents. First quarter revenue coming in at 59.7 million, just beating estimates of 59.6 million. Shares, though, down about 0.5 percentage point in the after hours.
All right, I'm taking a look at Sprinklr. So Sprinklr is a social media management software company. Now, in their last quarter, they already cut their full-year forecast for revenue and subscription revenue, and now it doesn't look so great. The second quarter revenue coming in at $197.2 million. That is better than estimated, but their net income looks really weird. It comes in at 1.84. The estimate was for 5.18. Something about that can't be quite right, but the stock is still getting hit down by about 10%.
Okay, I want to go to somewhere where I think none of us have ever been, and that's the International Space Station.
Oh.
Because even though there are earnings going on down here on Earth, there are a couple of astronauts from NASA up there on the International Space Station who were expected only to be up there for about 8 days. Instead, they're going to be on the ISS for about 8 months. Think about the type of planning changes difference you would have to make if you were packing for an 8-day trip versus an 8-month trip. What are the things you'd miss?
When I first read this story, I kind of panicked thinking, oh my gosh, the astronauts are not going to have enough food. They're not going to have enough toothpaste. They only packed for a week-long trip. But actually, NASA and the International Space Station do control for that. And they make sure that the ISS is well stocked with food, supplies, and equipment. And also voting equipment.
Oh,
you can actually vote from space if you're an astronaut.
Really?
Vote for space. This is my time. I actually interviewed Sunny Williams, one of the astronauts on the space station, who's up there for July 4th. So I didn't realize she was still up there. For some reason, I thought she was coming down, on July 6th or something. But
yeah, I wonder if was she expected to be coming. But by then, I don't know if they knew that they were going to be up there for 8 months. But
yeah. I mean,
she's an astronaut. Sound like they're still in good
I feel
spirits.
like this is what they live for, right?
Exactly.
They wanted to go to space. They're in space.
Yeah, this is what they signed up for.
But how do you secure the ballot in space for voting?
The Texas legislature passed something about this, and it's all done electronically.
Are you an election truther, Alex?
No, I don't. These are legit questions. Wait, can I just say this is the best part of this detail? They have to list their current address on the application, and the address they give is International Space Station, low Earth orbit.
But,
is that amazing?
Oh my God, I
love
that.
Is there an apartment number?
How many
put on there?
How many electoral votes? How many electoral votes does the ISS have?
I don't want to know. You guys. Oh my God.
Alex says, "Count every space vote." That's what she says. Guys, good to see you. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll be back tomorrow, same time, same place.
All right, stick with us. A lot more coverage coming up here on The Close. Doug Clinton, co-founder and partner over at Deepwater Asset Management. He's stopping by the big program next. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
I'm Romaine Bosta. Keep your balance, Scarlett, because we did see a lot of action in the market today, coming off that massive sell-off yesterday, and we got a massive lot of nothing here. It was kind of a topsy-turvy day. Stocks did spend a good portion of the day in the green, but ultimately kind of closed out the day flatline. 55.20 on the S&P 500, down about 0.2%, and that really was the story. You did see some disinversion in that key part of the yield curve, the differential between the 2s and 10s, though it did re-invert here, but that's been the talk of the town, only the second time that that's happened since 2022. The VIX elevated right around 21, and if you're looking for any bright spots out there in the equity space, it was kind of hard to find. In fact, a lot was down here on the day, particularly in the energy sector, the oil service sector as a whole, down 1.5%.
Yeah, I encountered the same issue trying to find some gainers. So let's start with the big movers that are on the negative side of the column. Let's start with Dollar Tree losing about a fifth of its value, joining Dollar General and Five Below and discount retailers that have really shown that those who target low-income consumers are getting squeezed, both by weak spending and tough competition from the likes of Walmart and Target. Dollar Tree cutting its full-year outlook. Verizon making a bid on a report that is making a bid and in advanced discussions, to acquire Frontier Communications, one of its rivals. You can see Frontier Communications up about 38% on the day. That, of course, has not been announced yet. That's just kind of what we're reporting at the moment. U.S. Steel plunging after reports that President Biden is set to block Nippon Steel's $14 billion takeover of the Pennsylvania-based steelmaker. And I point that out, of course, because Pennsylvania is a key swing state, and we know Kamala Harris has already made clear that she also opposes this acquisition, along with her opponent Donald Trump as well. So our understanding right now is that President Biden plans to kill the deal after CFIUS reviews the transaction and gives its decision. No wording on when that would likely happen. Now, U.S. Steel is not the only company getting caught up in the crosshairs of federal policy, because Intel is also front and center, and its unclear path forward is our top story this hour. The company's money woes are complicating the White House's bet that Intel will lead a revival of the domestic semiconductor industry. Intel was awarded $20 billion in taxpayer money under the CHIPS Act, but only if it meets certain milestones. We'll get into all of that later on in the program.
All right, but let's get back to some earnings that just crossed the wire. Sticking in that tech space, Hewlett-Packard Enterprises out with results, 10% earnings growth in the most recent quarter, a beat on adjusted EPS and guidance that is above street estimates, but you see the negative reaction in the share price right now. Maybe some concerns here about some of the segment revenues. Hybrid cloud growth down, intelligent edge revenue down, though server revenue up 35% here on the back of that AI demand. Ryan Vlastelica joining us right now to talk a little bit more here about what we learned here and kind of paint the broader picture here of what we learned out of this most recent earnings report. Is this sort of an AI story, or are we making more of it than we should?
Hey, thanks for having me. So it does seem like a mixed bag out of HPE so far this afternoon. The stock is down right now. It looks like the main thing people seem to be flagging right now is the free cash flow outlook. A little bit weaker than expected, maybe a little bit weaker than they were signaling before. So that's certainly a concern right there. But there were also some positives. It did seem like they raised their full year earnings outlook, and they did flag some strong demand for AI related servers. So mixed bag, but certainly the stock is down right now. It's been a little bit of an underperformer so far this year, and we have seen other peers like Dell in particular show some other strong demand related to AI.
What kind of commentary is the company likely to say that would really grab investors' attention, do you think?
Well, I think anything they have to say is going to be really, scoured by investors. People are, feeling a little bit more jittery about this trade than they have in a while. Obviously, we've seen pretty steep declines in NVIDIA and other chip makers over the past week or so. So if there's anything that is a little bit underwhelming, that could be a cause for a little bit more, of a pullback here in the space.
Is there some issue, Ryan, when we talk about this sort of broader AI trade? This has been the talk, and obviously that's largely focused on NVIDIA and some of the big hyperscalers. But investors have really been kind of searching for who else benefits, and a lot of people thought HPE and even just kind of these old school tech companies and Intels, even a Cisco might benefit as well. Is there still life left in this trade?
Yes, but I think you have to start being a lot more specific with who you're looking at right here. I think so far Dell has shown really strong execution here. And for a while, people were really paying a lot of attention to Supermicro. Of course, they've had some issues come up over the past couple of weeks of the delayed filing and so forth, which caused a big sell-off in that stock there. But certainly these server companies, this is kind of the first wave was on the GPUs and the processing side of things, and it seems like the next wave is going to be connecting these data centers and the server trade. One number I'm going to be looking out for is coming out tomorrow with Broadcom and their results. Different side of the chips trade, but certainly another name that's pretty being focused on within AI.
All right, keeping an eye on HPE shares down 3% here in after hours trading. Our thanks to Ryan Vlastelica there. Meanwhile, some shares moving higher in the after hour trade. MODG, Topgolf Galloway. This, of course, was a big mashup of a few different brands over the last few years. Those brands now going to be separated. One company will be focused on Topgolf. That's effectively the sort of indoor, and I guess outdoor for that matter, sort of golfing ranges. And then Callaway, which of course makes golf clubs and balls and other sort of paraphernalia. That will be its own separate company here. Apparently investors like this, Scarlett.
Yeah, apparently it's a bloated balance sheet because I was going to say golf seems to be doing just fine, the sport of golf overall. It got a revival during the pandemic and it doesn't feel like it's dropped off any at all.
I know, because trying to get a tee time this summer has been like, pulling teeth. So,
right, so from firsthand experience.
So if Topgolf Callaway, if this separation does anything to help that, please do. All right, we'll try to get you some more details on that, but when we return, we're going to continue our focus on the tech space and on that AI trade and take a look back in history at the father of modern AI development, John McCarthy. That's coming up next. This is Bloomberg. Now, given the media hype cycle since ChatGPT dropped in November 2022, you'd be forgiven in thinking artificial intelligence was something new. Its roots go back decades, centuries really. But it was a conference organized after World War II by computer and cognitive scientist John McCarthy, who was born on this day, September 4th, 1927. McCarthy is, in the eyes of his peers at least, the father of modern AI, even coining the term artificial intelligence. He started out as a mathematician, but became infatuated with the idea of whether computers could indeed show logic or symbolic expression. This after attending a 1948 presentation by Alan Turing, who was 2 years away from publishing his now seminal paper on whether machines could imitate humans. But the formal start of AI research is largely pegged to the summer of 1956, when McCarthy, along with Marvin Minsky, Nathaniel Rochester, and Claude Shannon, organized the Dartmouth Workshop, a 6-week confab where they brokered debates on ways to turn Turing's theories into reality. Around that time, McCarthy and his colleagues made a landmark development with the first computation program to perform problem solving. McCarthy, along with Minsky, would go later to set up MIT's Artificial Intelligence Laboratory in Boston, where they developed a first-of-its-kind programming language called Lisp, which still remains one of the dominant languages in AI and robotics work today. McCarthy didn't stop there. He helped conceive the idea of time sharing. It's a complex subject that in its simplest explanation became a precursor of cloud computing. That Dartmouth workshop, the MIT lab, and a second lab McCarthy set up at Stanford would lead to a surge of AI investment that swelled in the 1960s and 70s, ebbed a bit in the 80s, but reset at a fever pitch in the 2000s. McCarthy, who passed away in 2011, isn't around to see the latest multi-billion-dollar hype train, but he did foresee a lot of the missteps now being made. In an interview for the 1995 book, Thinking Aloud, McCarthy said AI researchers had made less progress than hoped, and that the major obstacle for advancement is not a lack of machine capacity, but our inability to write programs taking full advantage of what we already have.
All right, great stuff. Great context here. And of course, this is happening as we see a lot of skepticism around AI, at least in the recent days. However, our next guest believes, quote, we are in the middle of an AI bull market that will run for at least 2 to 4 years. Doug Clinton is co-founder and partner at Deepwater Asset Management, and he joins us now. Doug, I get that you are bullish long-term on AI, but I'm curious to get your take on what you see going on, how you would characterize the skepticism or the maybe concern, the jitters that we're seeing right now. You can just look at NVIDIA, for instance, whose shares are down for a second day, losing for a fourth time in 5 days. In fact, losing about 16% since its latest earnings report, which by all accounts, if you just look at the numbers, were good. They just didn't meet the highest estimate. How has the mood shifted?
Well, we start, Scarlett, with a simple question, which is, has anything really changed? Have we learned anything new in the last week, in the last month? about the AI trade that we didn't know before that would lead us to believe that it's over? And the answer is no. Nothing has really changed. To your point about the NVIDIA earnings, I mean, we own NVIDIA stock. We thought that they were about as good as they could be, given some of the questions around the delays with Blackwell, which turned out to be true. That product's pushed out roughly a quarter. And despite that push out, NVIDIA still got it up by 2%. It would have been more probably if Blackwell was on schedule. And so we don't see any reason to doubt the long-term potential, at least in our view, for what we think will happen for the AI trade over that 2 to 4 year period. Predicting the next 2 weeks, the next 2 months, that's harder to say. I think there's a lot of other things going on that investors are paying attention to, particularly around the seasonality of September in particular, and also the election cycle.
Okay, so you're referring to the overall weakness in equities around the month of September. Just sticking with NVIDIA for a moment here, because Bloomberg is reporting that NVIDIA now says it has not been subpoenaed by the U.S. DOJ in response to our reporting on Tuesday that the DOJ has sent it and other companies subpoenas as part of this broader inquiry into whether NVIDIA violated antitrust laws. How much of a factor is this in people's willingness to stay the course on a name like NVIDIA, or, because these kinds of investigations, potential investigations, take so long to sort out, it's not a real immediate issue for investors?
Well, historically, we do, fortunately or unfortunately, have a lot of examples of regulatory investigations of other big tech companies. And beyond sort of the day of the announcement, often those investigations don't seem to have long-term impacts. Many of them, to your point, do take years to play out. I would suspect the same scenario here for NVIDIA.
So, Doug, I mean, a lot of people are still trying to figure out kind of where the puck is going. And I know trying to figure out where AI leads us is going to be a sort of a long-term process. But when you look at how crowded the trade was around NVIDIA, maybe Microsoft and a few other sort of hyperscalers here, and that search for sort of a broadening out of it, where should we be looking? Do you think it is going to be with sort of the hardware type of companies, meaning the chip makers, software companies, or where should we be looking to kind of the alternatives, say like an Apple and maybe what they might do with the consumer-facing version of AI on their smartphones?
Romain, the way we have structured our portfolio is we are trying to invest in both hardware and software companies in both the public and private markets. We think that that combination will give you sort of the optimal exposure to AI. And what we've found is in the public markets, most of the hardware companies are these more mature companies like an NVIDIA, like a Broadcom reporting tomorrow, like TSM. They're available to equity investors who can just buy the stock freely. On the software side, it's harder to find software companies in the public markets that have true pure play AI exposure. Many of those companies are still private. And so to the extent you can, and that's what we love to do with our portfolio, is we try to find those companies in the private markets, invest in them there. And then I think we will start to see some liquidity for some of those companies coming public in the next 6 to 12 months.
All right, we will watch for that, certainly, and you'll be right there with us to give us your analysis. Doug Clinton is co-founder and partner at Deepwater Asset Management. Now, coming up, we're going to pivot over to politics because Vice President Kamala Harris is touting her economic policy. Terry Haines of Pangaea Policy will be joining us next. This is Bloomberg.
We will expand the tax deduction for startups to $50,000. We will provide low and no interest loans to small businesses that want to expand. And we will, and this is very important, cut the red tape that can make starting and growing a small business more difficult than it needs to be.
61 days into the U.S. presidential election, and Kamala Harris, the nominee in the Democratic Party for that presidential ticket, starting to finally outlay some details of her economic proposals. You heard her there speaking a little bit earlier at a rally in New Hampshire, offering incentives for small business. We also learned that she's also considering a 28% capital gains tax rate on high earners. These are people who make more than $1 million. That would be an increase from where we stand today, but it would be below what President Joe Biden has proposed, which is closer to 39 to 40%. Terry Haines, founder of Pangaea Policy, joining us right now to talk a little bit more about what we have learned here. And let's start with that capital gains tax rate here. Obviously, that only gets done with the support of Congress. And of course, we can have a whole discussion about Congress. But let's just focus on the idea of what you're even trying to achieve by raising that capital gains tax rate and what it would actually achieve.
Well, what you're doing, Romaine, in making such a promise, which, as you point out, I mean, I'm happy to bang on about this, but as you point out, almost certainly can't be kept anyway, thanks to Congress, is that we need to be taxing the rich more. The rich need to pay their fair share. So that's the kind of bell that's getting rung with that rhetoric. And if it's not as high as Biden's proposal, which was dead on arrival the moment that he made it, what Harris is hoping, frankly, is to soften a little bit in a bid to actually look more reasonable to business leaders that she needs to attract. Let's not forget her first step out of the box on economics was proposing price controls, and she's scrambling back from that, I think, and trying to look more reasonable and more economically responsible to a variety of business people whose support she needs in November.
It's kind of interesting that these two proposals come out on the same day. Obviously, one is going to appeal to a certain type of voter in terms of raising that tax rate. That's going to appeal to maybe some middle-income folks who feel like maybe they want richer people to pay a fair share. But also, I thought it was interesting that she would roll this out at the same time, talking about these tax incentives for small businesses here. So we're talking about potentially increased revenue on one side, but obviously on the other side, maybe a pullback of some of that revenue as well.
Yeah, I think you're absolutely onto something there. Political people like to pair things up, and so what we talked about the first half of the message. The second half of the message is small business is the incubator of the American economy. It's where a great deal of jobs reside. It's where economic growth happens. So what we're going to do is we're going to incent that. Of course, at the same time, that opens her up to the familiar charges that the Biden administration should have been doing a lot of that over the last 3.5 years. But it's a differentiator for her, and in that sense, it's probably a good thing.
I got to ask you, Terry, I mean, part of all these different proposals that Kamala Harris or Donald Trump are raising all has to do with the fact that whoever wins the White House this November will have to figure out a major tax bill with parts of the Trump 2017 tax cuts set to expire at the end of 2025. So if neither side does anything because Congress won't play ball, what's going to happen?
No, what's going to happen is the vast majority of these tax cuts are going to expire or get cut way back. I don't think the street appreciates this, in part because what the street likes to do at this time of year is talk about blue waves and red waves and all kinds of waves. In the last 3 presidential elections, we were all talking about blue waves. In the last congressional midterm in 2022, there was talk of a red wave. None of that really happened. And, you'd hope people would figure that out. But we're very much in the land of the dishonest here. You've got a situation where I think Harris is 60% likely to be elected, but I also think it's at least 70% likely that you have Harris or Trump with a split Congress. That's a barely Democratic House and a barely Democratic Senate. And Democrats are already lined up to say no to a straight-out extension of the 2017 tax cuts. So net, what happens, those get cut way back or they don't happen at all, depending on a scenario. And I don't think people are prepared for that quite yet.
How many of these different policies, prescriptions that have been raised could be done through executive orders?
Slim to none, I think. Price control, certainly not. You can talk about the tariffs, although I was about Trump tariffs, although I was amused that there was a major centrist think tank that came out today and said, first of all, that trumpeting that Trump's tariffs were going to be negative for the economy, and at the same time, in the same email, said that Trump couldn't do them anyway because that was really up to Congress. So, all right, so you can or you can't. But you've got those two to start. You've got, just in my little tick list, you've got national rent control, which certainly is not an executive action. You've got free IVF. You've got no tax on tips, which which would certainly take a tax code. Very little of any of that can be done purely by executive order, and anybody that doubts me on that has only to look at student loan relief to see that problem.
I do want to pivot here to some other policies that are kind of like baked into this idea of Washington having a bigger role in business. We learned a little bit earlier today here about the Biden administration's desire to block that Nippon deal for U.S. Steel, and we should point out that both Kamala Harris as well as I believe the Trump campaign have also said that they oppose this deal to some extent or another. We also, of course, had all of this money that came out of the IRA that was going to chip manufacturers in an effort, I guess, to reshore some of that manufacturing here. Is this going to be something palatable for voters going forward, this idea that Washington is going to have a much bigger hand in what's going on in private industry?
I think the whole technocratic dialing up and down, frankly, is misplaced. There's been, everybody walks away congratulating themselves on both Republican and Democrat, congratulating themselves on the U.S. Steel move. But in Western Pennsylvania, where I'm from, and my uncle was a steel worker and a proud one. You've had 30 or more years of people saying, we'll save the industry, we'll do this, we'll do that. None of that's happened. People there are deeply cynical about this. So and for good reason. So the idea that this is a magical, some kind of magical salve for electoral purposes, I think is vastly overblown. And the same with the whole Intel matter. I have said all along, I thought the major beneficiary of this election, regardless of who gets elected or regardless of what Congress there is defense spending, because there's going to be a in defense industrial base increase, and chips was part of that, but they're not invoking that with the steel deal at all. So, I don't think it's a particularly honest maneuver.
Yeah, and that would just fuel and add to the fiscal deficit as well, which is a whole other can of worms, too. Terry Haines, really appreciate your joining us. Terry Haines is founder of Pangaea Policy, joining us from Washington. Now, Romaine mentioned the chip companies. The White House has made a big bet on Intel to lead this U.S. chip-making renaissance. But that is in trouble now because Intel's mounting financial struggles could create a setback for the U.S.'s most ambitious industrial policy in decades. Bloomberg's Mackenzie Hawkins has been writing about this and joins us now with more. So, Mackenzie, a lot of this is centered around the idea that Intel's kind of the linchpin of what the Biden administration has set up with the CHIPS Act. It's due to get about $20 billion in grants and loans. Does this work without Intel's participation?
So Intel is a hugely important company for this U.S. effort, which sets aside $39 billion in grants plus billions more in loans, loan guarantees, and tax credits to try to convince the world's chip makers to build factories on American soil. There are three companies that make the types of advanced processors that the Biden administration really cares about: Intel and Taiwan's TSMC and South Korea's Samsung. So Intel's factories are important not just for reaching the goal of making a fifth of those cutting-edge logic chips by the end of the decade, but also because the company is supposed to be the sole beneficiary of a $3.5 billion program that would make secure chips for the Pentagon. So Intel is not, the entire CHIPS Act. There are more than a dozen other companies that are supposed to get some type of award and hundreds more that were interested in the funding. But you really can't overstate the company's importance.
Yeah, you can't overstate it. I mean, right now, most of those competitors that you reference, they don't have the capacity at all. I am curious, though, if you could kind of square the circle, though, because you have Intel basically saying, look, we're not getting these funds fast enough to do what the government wants us to do. And the government's kind of saying, well, Intel isn't really ready or whatever to do it here. And I'm not sure what to believe here. Why have we not found a little bit more common ground on a proposal, or really more than a proposal, that's been out there now for more than 2 years?
So Biden signed the CHIPS Act in August 2022, just over 2 years ago. And Intel, which was one of the biggest lobbyists for that law, was right in the door at the beginning to ask for the money. And they reached what was called a preliminary memorandum of terms in March. So Biden went to Intel's campus in Arizona, said, we plan to give this company $8.5 billion, $11 billion, or $8.5 billion in grants, $11 billion in loans, provided they go through due diligence and meet certain milestones. That's always been the plan, not just for Intel, but for every company involved in this program. And in the 5 months since that happened, Intel, which was already in kind of a rocky financial position, has entered truly dangerous territory. We had a pretty disastrous earnings report from the company on August 1st, and they're now considering increasingly drastic actions, such as splitting off their manufacturing division or scaling back their global factory plans. So the U.S. government doesn't want to give money to Intel or any company before they can be sure that they're able to deliver on their promises and until they've actually executed it. The money was only ever going to come in the form of a reimbursement.
That's a good point, Mackenzie. I'm curious, is there any sense here of a potential lack of continuity given the U.S. election? Obviously, if you get a new administration in Trump, I know there's always a risk there. But even with the Harris administration, which I guess on the surface is an extension of the Biden administration, is that still a guarantee that this program, at least in Intel's favor, would continue?
So there's no reason to think otherwise, but I think the bigger question here is chip industry leaders have always warned that $39 billion, while it's a lot of taxpayer money, isn't actually that much money for the semiconductor industry, barely more than 1 year's capital spending by a top chip maker. So there's all this talk in Washington about what could a CHIPS Act 2 look like. And I think a question that will face either the Harris or Trump administration is whether that's a priority, and if so, what form it should take, priority on grants and loans, or what is potentially more likely an extension of a 25% tax credit that companies can get for manufacturing projects on U.S. soil.
All right, Mackenzie Hawkins there, a Bloomberg News reporter. Great story out on the Bloomberg terminal right now. Taking a closer look here at kind of what ails Intel, particularly in the context here of that Biden administration plan to provide as much as $20 billion in incentives here to try to reshore some of that chip manufacturing, really kind of build it out. And, you know, this was kind of supposed to be the lifeline, I think, too, for Intel and Gelsinger, not just the dollar amount, but really just the idea that they were going to be the focal point of sort of this, I guess, renaissance in U.S. Chip manufacturing.
Yeah, but I like what Mackenzie said, which is this was always going to be in the form of a reimbursement. They have to show that they're capable of delivering on what they promised before they get any of the money. Kind of like the way that I would dole out money to my teenager. He's got to do his chores first before he gets his allowance.
How's it working out? It's not working out so well for me.
It doesn't always work out that well. You know, speaking of chip makers, the Philadelphia Semiconductor Index finishing just up slightly, 0.3% today, rebounding from yesterday's 7.8% plunge. You can't say the same, though, for the S&P 500 or for NVIDIA, which is down for a second straight day, fourth decline in 5 days, 16% lower since its earnings report.
Yeah, it'll be interesting too. I mean, there's a lot of talk about how the AI trade is over. It'll be interesting to see if this is a blip. Keep an eye, though, on those last two lines there. I thought it was kind of interesting. I mean, once again, you had bond market volatility really outpacing stock market volatility, and that probably only going to get worse given jobs on Friday and then, of course, a big Fed meeting in a couple of weeks.
This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Rob Arnott, the Star Fund manager and founder of Research Affiliates, is launching an ETF to buy up index rejects. We're talking about companies dropped from the S&P 500 and Russell 1000. The ETF IQ team and I spoke with Arnott earlier today.
This is just a really neat niche idea that we wanted to bring to market. So I had to wait 70 years to partner with ETF architects to launch an ETF based on deletions. What could be better than buying the rejects?
And, you know, this ETF, when it launches, is the equity equivalent of the Fallen Angels ETF, which tracks companies that have been downgraded to junk status, companies that sell debt.
Yeah, I think it's interesting, too, though. Is this, though, I mean, the whole dividend side of it, though, I think gave me pause here. And I ran into him right before he came on ETF IQ, was asking him about this, because, you know, I feel like in the old days, that sort of mean reversion back to dividend status would mean something. But now so many companies are just like, we don't need to pay a dividend. And if you somehow manage to wiggle out of paying one, I don't know. Do you need to go back, or maybe just do a buybacks or whatever, you know, otherwise?
I mean, he says his research shows that companies that are deleted from these indexes tend to gain 5% a year for the next 5 years on a compounded basis, at least. So there is room to just, you know, go bottom fishing, looking for deep, deep value here.
All right. Well, the founder of Smart Beta finding another angle here that might actually catch on. Meanwhile, I'm keeping an eye on Eric and Peter Nordstrom. Of course, they are the scions of the department store family, and they are looking to take their family company private again. Of course, it is a publicly traded company, a company that I think they've been kicking the tires for a while now, trying to take it private. They've now apparently assembled enough for a $3.8 billion deal. This involves a Mexican department store chain that I didn't even know was involved. That I guess has about a 10% stake in Nordstrom. So it'll be interesting to see if investors, though, are hospitable to this.
Yeah, Liverpool was also involved in the previous effort back in 2018. However, the shareholder base rejected that offer, saying the price was too low. The price of Nordstrom shares has only gone down. So it might be a premium to the price that the stock was trading at before the discussions became public, but still going to be a pretty high bar for shareholders to go through. All right, third on the docket is Jessica Pegula. She is the tennis player and daughter of Buffalo Bills owner Terry Pegula, and she's playing the U.S. Open quarterfinals tonight. She's ranked number 6. She's actually made it to the quarterfinals the 7th time in a Major 4 tournament, but she's never actually advanced further than that.
Yeah, I mean, it's interesting character. You know, I kind of like this kind of phase of tennis right now. I mean, because we've kind of lost the greats. You know, obviously Serena's moved on, and you've got Djokovic got bumped out, and who was it? Who just retired. But so and now you've got these sort of younger folks, a lot of folks that people are still unfamiliar with, and maybe they do become those next big stars. I don't know if it's her or not, but I did not know that she was actually the daughter of the Buffalo Bills.
You know, she had posted on Instagram a picture of her riding the subway to the U.S. Open, which is in Flushing.
Yes, which is a smart way to do it.
Which is the smart way to do it.
Don't try to take a car out there.
But so the interesting thing is a lot of people on social media were really surprised because they thought that she would get chauffeured everywhere. She takes a private jet everywhere because she's the daughter of billionaires. Yeah. And she pushed back against that. I was like, no, that's not how I roll.
Does she not get like a helicopter or something there? Do they have a place for her to land out there in Queens?
She was taking the 7 train all the way in.
But you know what I love about that? If you ever ride that train to the U.S. Open, you'll see a lot of celebrities on that train. No, like even the ones attending, because like I said, trying to get in and out of there in a car can be a hassle.
Absolutely. All right, still ahead, we've got what investors need to watch for tomorrow's trade. This is Bloomberg. We're keeping an eye on earnings because earnings season is never over, and Broadcom is due to report tomorrow after the closing bell. Bloomberg's Red Brown joins us now to discuss. So, Red, Broadcom could have some good news when it comes to its AI sales because it has secured another customer. What is the company likely to say about all of that?
Yeah, that's definitely what we'll be paying attention to is where their AI sales will be headed this quarter. Last quarter, if we remember, the company said that they now expect to bring in around $11 billion from their AI sales in 2024 because of so much of the spending that we've seen all of big tech throughout this past earnings season be putting towards building out their AI infrastructure. Analysts have been kind of consistently increasing their expectations for that number throughout the quarter. Right now, consensus for their AI sales sits at around $11.8 billion. We've seen some analysts throwing their number 12 billion around quite a bit. But overall, the feeling is that the view is quite conservative from the company so far. Yeah. So that'll be kind of the main thing that we're keying in on is whether or not they will improve that view.
Is there any sense here that what we hear from them tomorrow would change kind of the complexion of this AI trade? I'm sure that you've seen a lot of people are starting to doubt.
Yeah, I mean, I think given what happened last week with NVIDIA's results, that's kind of really intensified how important Broadcom's report will be this week. You know, it has potential to be, I don't know, maybe the final nail in the coffin of that trade. But again, I think analysts are broadly quite optimistic for Broadcom. Again, they kind of dominate this the special chips, these kind of one-off chips for a lot of these companies that they need to complete these projects. They've really kind of cornered that market. So so overall kind of sets up a pretty positive backdrop for the company.
All right, well, investors are definitely going to be keeping an eye on it. Broadcom out tomorrow. Red Brown, of course, we'll have full coverage right here on the close as we push ahead to tomorrow to some other market-moving events, including some economic data, Scarlett.
Yeah, we got the JOLTS data today, which was fairly weak and set off this big Treasury rally. So we're looking for ADP payrolls numbers along with weekly jobless claims, and you also have ISM services in the mix. We
also are going to get some earnings. We just mentioned Broadcom there, but another one too that might actually be of some interest, the pandemic darling. DocuSign, out here. We'll see. I don't know. Are you still signing things by DocuSign?
I am. Yes,
okay, so we'll see how they do tomorrow here. And then we got the NFL season opener, a revenge game for Lamar Jackson versus Taylor Swift tomorrow, Thursday night.
Yeah, the Ravens will be playing at KC. against Casey, obviously. So, will Taylor Swift show up? That's the big question. Is she going to sing the national anthem?
I just want to know, well, how many snaps is she going to take? That's all I want to know here. And we should point out that tomorrow, wow, we're going to be talking a lot about sports.
Yes, we are, because we've got you covered on every angle with some of the industry's biggest tastemakers. We're talking Drew Brees, the future Hall of Famer, of course, Super Bowl champion. Steph Curry, Under Armour CEO Kevin Plank will also be there. And you also see there Dan Hunt, the co-owner of the Kansas City Chiefs, along with his brother Clark Hunt. And it's all part of the Power Players conference.
This is a fantastic lineup. I mean, you're part of this, right? You're doing a couple interviews as well at this thing. And it's great because, I mean, it gets to the kind of the heart of, I think, what we've talked about a lot, about just how much bigger of a business sports has gotten. It's always been big business, but it's just expanded so broadly. It's not just baseball, football, and what else am I forgetting?
Hockey, baseball.
Hockey here in the U.S.
Yeah. No, absolutely. There's a limited supply.
Basketball,
there's a lot of demand. Oh, basketball. No one watches basketball. I'm kidding. And of course, the institutional money is heading into this uncorrelated asset class.
Yeah.
There's a lot of appeal.
Is that big, right? All right.
LeBron James thinks so.
That does it for us here on The Close. Please join us tomorrow. In the meantime, stick around. All your politics coverage coming up at the top of the hour with Balance of Power on Bloomberg.